Hello, everyone. Thank you so much for joining us again for another weekly wrap up. My name is Jeremy Cronemeyer. I'm the operations manager for Wickham Financial Group. And I also have here Graham Wickham, president and CEO of Wickham Financial and Insurance Services. Graham, what happened in the markets last week?
Yeah, thank you, Jeremy. Thanks for our listeners again jumping on the call. Yeah, we really saw the indices really fall sharply. We saw the Nasdaq, we saw the Russell 2000. That's a small cap index. They were down over 5.5%. We saw the S&P 500 down about 4%, led by technology and the energy sector. Now, from an energy standpoint, we did see OPEC come out and delay production hikes after crude oil fell so much. It dropped about 7.5% off of some weak economic data that they had seen from the US and China. From a US Treasury yield standpoint, that was a huge drop. They fell steeply. We saw the 2-year dipping below the 10-year yield, indicating expectations of maybe some larger rate cuts that might be coming this September from the Fed when they meet. Now, from a labor standpoint, we saw some mixed signals. We saw non-farm payroll that rose about 142,000 in August. Now, the unemployment rate, now that ticked down to about 4.2%. From an economic data standpoint, overall jobs fell to the lowest level since 2021. Layoffs increased where we saw the ISM manufacturing, and some PMI came in just below some forecasts, raising some initial concerns of recession, so on and so forth. Even though we feel that might be a bit unfounded at this point, it's still concern just the same. Going overseas and looking internationally, you saw the China disappointing with some PMI numbers. So we're really struggling with some growth over there. We saw the Bank of Canada cut their benchmark rate by 25 basis points, and that dropped it down to about 4.25. Keep in mind, that's a lot lower than we are right now, with our Fed rate being in a range of about 5.5-ish right now. Now, if we look at this upcoming week, we're looking at U.S. is primarily in focus. So we got a big debate that's happening this week for the election. We'll also have the CPI will be released on Wednesday that'll be released. And then we'll be looking at some interest rate decisions coming out of Europe. Central Bank, we'll be looking at rate decisions coming out on Thursday. And I think some expectations with the ECB is that they're looking to lower the benchmark 25 basis points, bringing their overall rate down to 4%, again, compared to ours being in the mid fives. Some other economic data, we're just going to be lower in forecasting. Some forecasting will be coming out for inflation. Some U.S. data, we'll be looking at the consumer credit, looking at small business sentiment, primarily consumer sentiment, and then we'll be wrapping some things up with some inflation expectations. I'm having trouble talking right now. Inflation expectations for September. If we go over globally, we'll just see the UK coming out with their monthly employment update on Tuesday. China will be reporting some inflation figures, some trade balance figures pretty early in this week. Jeremy?
Well, thanks, Graham. We appreciate the information.
Yep.
I did have a question for you. With the Fed looking to lower rates here coming up here in September, what do you have for some considerations for people that are kind of holding on to a lot of money market assets right now?
No, I think that's a great question, and that's something, a message we've been getting out. And I know our industry has been talking about that a lot. You know, you have options, right? I know money market rates have been so high for so long. You're not necessarily going to lose money in those, which you could, depending on how they are. So those aren't guaranteed. But when the Fed starts lowering the rates, you're just going to be making less, right? So what we're generally saying is you got other categories. You can go into increasing duration, meaning increasing those maturities, right? So you might accept a little bit lower interest return, but you might get some capital appreciation. You can do that with the government bonds, agency bonds, which are pretty unique right now. Municipals, unique side to that whole market is that if you own municipal debt in the state that you live in, it can be double tax free from state and federal taxation. Then obviously you can always look at corporate debt that's out there, and then even go overseas. I was just talking about interest rates. Listen, interest rates are coming down a little quicker, a little faster, at least initially right now, than they are in the United States. So international fixed income can certainly be an area to explore as well. And these would be not direct comparables to a money market. I don't want to paint that picture that they're like guaranteed or that type of safety. You're still going to have risk in anything you do. So just understand what risk you're taking, increasing maturities out, duration out a little bit, maybe stagger into that, and that can help you with those money market rates coming down over time.
Gotcha. We always appreciate the expertise, Graham, and we appreciate our listeners. To our listeners, check out our social media, check out our website if you want to check out these weekly wrap-ups from past or whatever in our webinars. And we always appreciate the information, and we look forward to seeing y'all next week.
Take care.